to disrupt the legacy stablecoin models that we have in the market. Who would have known that we already have legacy stablecoin models? Everyone knows, however, that we definitely need something different as we're on the precipice of stablecoins really going mainstream. And that's the point of Global Dollar Network. It's an open network where the members share in the economics and the future of the network, and they are the owners of this network. So really, thanks to everyone here who helped bring this together to put this on and is participating today. Now I will just introduce Andy Baer, and Andy is the head of product at CoinDesk Indices, and he brings over 25 years of experience in global markets and an enormous wealth of knowledge in crypto and beyond, and we're super grateful to have Andy here to moderate a handful of great conversations and sessions. So turn it over to Andy. Thank you.
Thanks so much. This is really cool because in the index business, we're building indices for financial products, for investment products. So we don't get to spend a lot of time talking about stablecoins. So this was my, it's like a barter. I get a full immersion day of stablecoin, and you get to hear the dulcet tones of my voice for 2 hours. So everybody wins. We have a great first panel to start with. Rather than machine gunning introductions, I asked each person to give a 2 or 3 minute introduction of why their business changed and morphed to make way for a stablecoin practice that would help in the sense that Global Dollar Network is starting. It has started, and I'll start with Sergio for that.
Thank you everyone for being here. I'm Sergio Mello. I'm the head of stablecoins at Anchorage Digital. And to frame it right, we have to say that usually an initiative needs to find the right time and the right place to thrive and to ripen. Well, for stablecoins, we needed to find the right time, the right place, and the right regulatory environment. Finally, this is happening. We've been through 4 years of darkness, I would say, where the rest of the world was outpacing this economy in getting up to speed with the financial system. So to answer your question more directly, what we're witnessing here is a rewriting of the financial layers of the financial system with decentralized ledger technologies first and stablecoin after. We can add disruption within disruption in how we can rewire the system and have money flows cross the layers in an intermediated and disintermediated way. So Anchorage Digital is playing a role in here because owning the first and only crypto charter by the bank regulator, we have a very unique view of how a regulated environment money flows can happen and can happen with digital assets.
Fantastic. Raj, could you give us a story?
Yeah. Hi, Raj Damodaran from MasterCard. Look, we, at the core of at MasterCard, we are about moving money and value, and we've been doing that for decades across a number of use cases, the most prominent of which, of course, is the cards that you have in your wallet today. When we looked at the space a few years ago, and we had more R&D kind of approach a few years ago, looking at whether blockchain tech can be used to move value. And when the right conditions came, and some of it Sergio spoke about, the clarity on the regulation, clarity on what kind of currency formats are valuable to solve consumer pain points or merchant pain points or business pain points, we thought the moment is right to set up a full dedicated entity. This happened a few years ago, and I helped found it, and I lead it to this day.
Fantastic. Ahmed?
Hi, everyone. Ahmed Zifsaf, head of crypto partnerships at WorldPay. If you're not familiar, WorldPay is a very large global merchant acquirer, payment processor. We do about $2 trillion in payments volume a year. Have millions of merchants around the world that we count as sort of the biggest global companies you might interact with. And we really view ourselves as like the payments experts for our customers worldwide. So when it comes to crypto and the crypto industry as a whole, about 10 years ago, we started providing these types of services to exchanges, wallets, sort of your bread and butter of the crypto industry, getting retail users and businesses being able to go from fiat to crypto. Now, when we look at today, 10 years later, we still view ourselves as the payment experts, but what's the next evolution of this technology? A lot of it is the stablecoin infrastructure. And why? We find that you can do things a lot quicker for our customers. So You take the likes of global retailers who have to deal with many regulations and sort of jurisdictions and things like that, and FX issues with swapping between currencies. And now that we're at this stage, sort of within the crypto industry, you can really see the value of adopting this technology and starting to blend the worlds between TradFi and DeFi and everything in between.
See, what I was hoping for was a story like I was sitting in the corner working on stable coins and everybody else is doing their business and they're looking at me funny, and now they're looking at me like they want to be on my team. But that's okay. You guys did, that's standard introductions. That's fine. Raj, one of the things that we talked about earlier was I can wake up at 6 a.m. on Sunday and go buy a cup of coffee and a bagel with my MasterCard. I don't need to worry about settlement on a Sunday or anything. As far as I'm concerned, you know, stablecoins wouldn't really add much to that perfectly suitable experience. So what's causing the demand here? What's causing the shift?
Yeah, you're absolutely right. To wake up and get a coffee or go to a Subway, you don't really need stable coins in that ecosystem, and the cards really work well. But what we are seeing is, even in the last couple of years, crypto wallets, all the way from kind of central, exchanges that offer, like the likes of Kraken, Crypto.com, OKX, and so on, offer MasterCards, all the way to, say, we have a card with MetaMask now in Europe where you can actually get a card from your self-custody wallet. But all of those players today liquid in stable coins. They conduct their business in stable coins, and they want to be able to settle with us in stable coins, for example. And that's the choice that we provide. And that's how we initially got started with this. Now the demand is on the merchant side as well. Is recently, a couple of weeks ago, we talked about Newway offering stablecoin-based settlement to merchants. Again, that's a consumer-driven demand. Many of the emerging markets and merchants would like to receive in stablecoins, especially in US dollar-based stablecoins that may change, different currency-based stablecoins. So it's really driving from that perspective. And end of the day, we have now millions of stablecoin linked cards that consumers can actually use as store of value and spend wherever they want. We have 40 million merchants around the world where you can spend. And that kind of everyday utility to your balances held in stablecoins is really powerful. And I think we can move beyond from that. And there are a number of use cases where this can benefit greatly and where we have a critical role to play. Remittances, disbursements, and I think those are just getting started. At the core of it is really providing choice to our partners to be able to pay with what the currency they like and get paid in currency they like. And that choice is what played itself out in 150 plus currencies around the world in our card network. And now we have a new choice to add, and it has unique features, which I'm sure we'll talk about it all day today.
Absolutely. I want to get back to you on a similar question about how things get started. But first, Sergio, I think of Anchorage as a hedge fund serving custodian for trading, for custody that supports hedge fund trading, which was a great business. And you guys were out first and got yourself a bank charter and, got into a special category of custodians. This seems a little different, right? A different segment, a different customer base, a different mission. That's a pivot that I think I'd like to hear more about.
I would call it more an extension. It's not really a pivot of the core characteristics of custody and settlement. After all, stablecoin is one of the instruments that you could transact on digital rails, but really the core custody and settlement and governance mechanics are the same. But definitely it is important to understand that stablecoins are meant to be moved, not just to be held. And what they're going to disrupt most in the next year is sweep accounts and treasury management, cash management for large corporations. That's where we see that big overlap between our traditional clientele of institutional, which can span from hedge funds to banks all along, and crypto protocols. All the way to nimbler and more exciting, exotic payment companies, all the way to the platforms like my two co-panelists actually make it all happen. So while stablecoins are natively a crypto asset, they also disrupt the traditional financial system. And so it's coming to us. We don't really have to change dramatically the way things work at Anchorage, but the business is naturally and natively transitioning onto digital rails. So we have the platform that can serve that. We
wanna
want to
ask
see
a-
it that way, which doesn't mean we don't have work to do. I'm very busy, but but it's I don't have to change the way we work. That's what I'm saying.
I just want a quick follow-up on that, because with the rise of enhanced collateral that especially hedge funds and institutional traders are using, whether you're using tokenized money market funds and such, yet trading in stablecoin pairs, Bitcoin USDC, Bitcoin USDT, right, is where the liquidity is. So this, you inspire this question by the idea of movement of the stablecoins, right? I mean, in an optimal world, I'd have my collateral enhanced up to the moment where I need liquidity to trade, and then I want to be back on chain into a stablecoin so I can buy what I need to buy or sell what I need to sell. Has, in the last 12 months, as these enhanced collateral vehicles have gotten bigger and bigger, 4 or 5 billion now, have you seen more and more movement?
Yeah, not only more movement, but the programmability of the stablecoin yield sharing mechanics, and that's why the global dollar was born in the first place,
Right.
is what really makes a difference there. So the fact that you can decouple the yield accrual part of the money instrument from the payment part of the money instrument, and having programmatically move across the layers. So going back to my first sentence, having direct lines across the layers of the financial system is what really stablecoins are disrupting here. The fact that we no longer need sweep accounts, no longer need treasury rebalance, or you can do it in an instant. That's where it makes a difference.
Right, right. So you may still decide to have a long-term collateral position held in a tokenized treasury or money market fund as a choice, but in the future, you shouldn't need to escape a stablecoin right away just because it's not yielding something in your collateral account.
Exactly, it's the
Yeah.
same instrument with knobs that you can turn when you want to change the financial behavior.
Super exciting. Go back to the first point about WorldPay being a company that's been doing this a lot. You mentioned the example of I buy something in the store, I tap my phone, and somewhere between me tapping the phone and maybe on the third time getting it to register that I've tapped, somewhere between there and the merchant getting paid, WorldPay has verified, has moved something, has participated. That's a pretty good business, right? So how did stablecoins sort of introduce their way into that idea, into that concept?
Yeah, I would say it kind of comes from like two angles. There's like the crypto native companies where they want to essentially keep like all of their payments on chain. So if I'm getting fiat in, can I still get crypto sort of out after someone makes like a purchase of Bitcoin with their card? The second element is sort of in our traditional flow that you're talking about. After you tap your card, you're still kind of restricted by banking hours, public holidays, and if you think of it on a global scale, there's all sorts of different variations of that. So countries like Brazil, it can even be much longer than a day or two. It could be something like 30 days before you receive your payment as a merchant or retailer. When you look at stables, you start to see this world in which you can settle instantaneously or many times a day. And then kind of to Sergio's point, you can start to move into like very more like sophisticated uses of your funds. So you can use this programmable money to immediately go into treasury management. So you can start to see how you accelerate all of these sort of payment and financial flows through the use of this asset because it has all of this sort of great advantages of being internet native. So I would say like that's how we started getting into it is understanding like, oh, can this technology make our payments go through faster and settle faster? And then after that, can we start to share in yield? That's something you couldn't really do before. You would have to kind of deposit into their bank account and then it's sort of in their world. So from a WorldPay perspective, it just allows us to keep on the cutting edge of payments and allows us to kind of advise and sort of be a guiding force into how our customers adopt this technology, which I think is really great for consumers and businesses alike.
So you talked about identified demand, and Raj, you and I talked earlier about, or you in your introductory remarks about identified demand, that you weren't building all of this into a vacuum. There were enough crypto native users or on-chain value holders that basically demanded the service. When did that get significant enough for MasterCard to sort of look up and say, we should address this? And they're in different countries too, so you had to deal with different regulations and different stablecoins. Massive project.
Yeah, I think this goes back into the role we play in this whole ecosystem. One, we talked about the cards, and the cards came organically when exchanges came about, and you found that consumers started to build more value in the crypto ecosystem, and they needed access to that value. And how do you provide access? The easiest way to provide access to money that you have, spendable money you have, is through a card. And so it's natural that we have a role to play there. I think this also tells a larger story about the role that we're seeking to play in this ecosystem, right? At the stablecoin, at the core of it is really about a raw money movement layer. It can be many other things in terms of the programmability and so on, and yield and so forth. But at the core level, as a payment company, we look at it as a money movement rail. But that by itself doesn't bring utility to the ecosystem. The way we embrace stablecoins and cards provide a example of how existing framework of how consumers go to millions of merchants, where you can walk into a random merchant from your point of view, accepting MasterCard. They can choose what currency to receive in. You can choose what currency to spend. That happens. So we look at the same way when we look at the new use cases as well. For example, cross-border remittance, people talk a lot about the potential for stablecoins. At the core of it is, again, the money movement layer. That's just the core building block. End of the day, for end-to-end remittance to happen, millions of consumers are still with the bank accounts or telephone, mobile wallets and so forth. The money need to get to where people are. We can't force people to get to a stable coin-based wallet for that to happen. So how do you make this end-to-end connectivity on and off ramp work in a safe, secure way? And we think we have a role to play. And you would see us continuing to launch products.
Right. So you're aware of all the ad hoc ways people are holding on to stable coins in places because they don't know any better, and that's the best they have. And this is looking to firm that
to
up.
build use cases from the core money movement layer, you really need to bring a whole ecosystem together. That's when it becomes a network. Network means common set of rules. So whether it's a card payments or remittance or B2B payments, each one has its own complexities that need to be offered as an overlay service. That's when use cases come, and we hope to play that role across the spectrum. Obviously, we've started doing that in cards. We've started doing that with remittances, and you can see us looking at other use cases over time.
Sergio, one of the things I hear from custodians is if a trade comes in and it's on 10 different blockchains, settlement itself can be a handful, right? It's an issue. It's I think, do you expect stablecoin activity to start to focus on a smaller number of blockchains? How does this affect your ability to conduct custody? Will this rationalize at some point, or do you just have to serve people on the blockchain they prefer?
Well, I have two observations there. One is that my personal point of view is that there's only one money, and in my ideal dreams, I see no distinction between fiat and stablecoins. Stablecoins are a better representation of fiat, a better way to transfer fiat, but it's really just money that you're moving and value. Today
That's a nice ideal. I like that.
But we're making it happen.
Yeah.
I mean, we've been working hard for 4 years under a very adverse regulatory environment, but finally now we have the tools for making it happen as an industry jointly, and everyone's playing their role from the network and the PSP and the custodians and the payment companies. Everyone is adding a little component to this money flow. Purely from a settlement perspective, it's important to understand that settlements have always been considered something that happens after, whereas now with stablecoins you're merging the transport layer and the value layer together in the same instrument. Mm-hmm. And so you also have to start reconsidering what happens when an authorization also means a clearing and also means a settlement.
Right.
In the
That's
same
an important point. The value layer and the transmission layer are the same thing, right?
Exactly.
Yeah.
So
Yeah.
clearly that there's differences. The way we've solved it, and I encourage, is by launching a platform called Atlas that can hybridly execute operations on the fiat world and on the various blockchain networks, and have everything happen in qualified custody, so that our clients never lose the qualified custody chain of value throughout the settlement, multi-party, single party, two parties, etc.
Do you think about that too? How many blockchains you're going to have to serve, or do you want to kind of corral everybody into one or two? I know we have Solana people in the room, so maybe you want to just direct.
They're friends. They're friends.
Okay.
I would say like a company like WorldPay, we operate at such scale. I don't think there's a world in which we're going to select or be exclusive with any particular blockchain. But that being said, there are popular and sort of more enterprise-oriented blockchains that just makes natural sense for WorldPay to partner with. We are pretty active in kind of getting on the ground for like new blockchains. So we do operate a variety of different like nodes, so that we can kind of like learn from the genesis of like new platforms and new technologies. But that being said, when we go and scale and you want to work with like very global companies, global airlines, global retailers, whatever it might be, you have to use sort of the most battle-tested technology and battle-tested platforms. So you end up working with the likes of Solana or some of the more premier blockchain companies.
You just mentioned Solana, nobody else. That was good. That was
well,
solid.
they're in the room. I'll just say that I also think interoperability becomes like a really important point as there's a proliferation of both stables and networks. So being able to be agnostic and still be able to kind of have the advantages of transparency and all of that. Yeah.
Raj, will public blockchains in general be able to work long term, or will there need to be where's the privacy layer?
Look, public blockchains are here to stay. It's not going anywhere, we think, and we think most of the utility of the stable coins, for example, comes from the fact that it's available in public chains and a healthy competition on that chain ecosystem that brings the costs down. That is, I think, is very, very, very good. The privacy, I think, there are a lot of enabling technologies that allows for anonymity on the privacy on the chain, but a lot of that need to come through layers above, right? So end of the day, for example, we have a crypto credential which enables remittance. A lot of the PII information exchange, travel rule compliance, all of that is done off chain. And people agree on the kind of transaction that they're going to post for a purpose. The purpose has been agreed to, counterparties have been agreed to, and the transaction gets posted on a chain that looks like any other transaction, but a lot of the data behind that is being exchanged off chain. And you're going to see such hybrid models emerge. End of the day, another challenge that need to be solved for with the number of stable coins, number of chains, we are starting to become, the oneness of money is kind of starting to become challenged, and that also need to be solved by the ecosystem for this to really scale. And as I was giving an example earlier today, when you transfer money to another person and that person is at the bank account, end of the day, that off-ramp need to work. The end-to-end connectivity is important, and if you really want to bring the utility of this beyond the trading for 90% of the stable coins used for today, we got to solve for all those, right?
Fantastic. We're going to start to wrap up, but Sergio, I want to ask you how things have changed as the velocity of regulatory change has crept into the United States. Well, in Europe too. So I'm sure that MiCA has been a big opportunity for you, but here you're Miami-based, and suddenly things are looking very different. So what's that acceleration felt like?
Well, yeah, that was my opening remark.
Yeah.
So it's clearly the most important item on our roadmap is understanding how quickly we can move.
Right.
And it's obvious that the next 3 years are the fastest we will ever see in the development of digital assets. But what's also interesting to note is that a lot of foreign regulators have really just been waiting for this moment as well, from Singapore to Korea to
I was
Brazil.
just in with MAS a few months ago, and they have changed their the velocity of how they're talking about things.
Exactly, and
Yeah.
so still the US plays a driving force in global regulatory standards.
Leadership, yeah.
Leadership, exactly. And so I think 2025 will have clarity here, 2026 will have clarity elsewhere, and 2027 is when it's all going to happen. And final remark, the name of this event today is Network Effect, and that is probably the answer to all the questions we just debated here, is when you have a critical mass of institutions that jointly understand and decide to use a common instrument, a common layer, a common technology, a common platform, a common blockchain, and we've seen Solana taking that lead in making all institutions be comfortable with using a system that is not too hippie and not too obscure, but has the right tune of institutional tooling and onboarding experience. That's where the money is going in the next 12 to 24 months, specifically for the payments industry.
Fantastic. We'll have to leave it there. Thanks, Sergio, Raj, Ahmed. Thanks very much.
I think as
Next panel is coming right up, so we'll just exchange. Yeah, you can leave the mics there. I'm gonna just grab my cane. Good. Everything's good. I'm just gonna grab my cane so I can hold on to it up there, but good so far? Okay, good.
Maybe no notes. Is that no notes? Easy, perfect.
Good. Okay. 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 Nice to see you. Hi again. Okay.
This is so refined. This is like the most refined.
This is the nicest room I've been in since I've been in crypto, I gotta say. Maybe the DCG office has been nice. I don't know if anybody's been up there. Okay, so we're on to our second panel. Let's get started with some introductions. Would you mind kicking us off?
Sure. Hey, everybody. Sunil Sachdev. I head up embedded finance at Fiserv. Fiserv is a company that's in a very privileged position in the commerce ecosystem. We have relationships with over 15,000 customers, mostly financial institutions on one side, millions of merchants on the other. And we talked a lot about in the previous panel the exchange of value and money between nodes that you trust. We feel like we're in a great position to help support the network effect. Looking forward to the conversation.
I loved our prep call, Rachel, and you brought up a couple of cool points I want to emphasize here, but maybe give the folks a bit of your background and how you got to where you are.
My life story. All right. Hi, everybody. I'm Rachel Andrica, and I am the head of global operations at Anchorage Digital, and I'm the COO of Anchorage Digital Bank, as Sergio mentioned, the first OCC chartered crypto bank. So I've been with the company for actually since the inception of the charter. But my background is actually in bank regulation and enforcement, compliance, et cetera, and moved into an operational role. And so for anybody who doesn't know who Anchorage Digital is, we're a custodian. We mostly serve hedge funds, VC firms, high net worth individuals, and as Sergio mentioned, kind of expanding the remit of our services, particularly as it relates to stablecoins.
You just wanted to wear Vans to work, and this is what it took, basically,
pretty
right?
much.
Yeah. Okay. No, that's cool.
Sambas sometimes. Depends.
I admire that. Luca, tell us about Cross River.
Morning, everyone. Luca Cosentino, head of product at Cross River. Cross River is a fintech-sponsored bank, New Jersey chartered, but we operate in 50 states. We've been in business for many years. We've been in the crypto business for many years. At our core, we offer everything as a service in banking, payments, and lending. So we take the core banking activities. We have a very cool layer of APIs on top of a core that we built internally. And so you can really come to us and get very specific products all as a service for you. I mentioned that we've been in business for a few years. We've been processing on-ramping for Coinbase for quite a few years now. And then over the many years, we've been supporting a very good percentage of the crypto business, especially in the US. And we're very excited about the industry in general.
So I'll stick with you for a minute. This is not how the company started, right, in crypto, yet you, like the folks on the first panel, it started with demand rather than sort of exploration, right? People were coming in and saying, I need help with this. What were those first couple of conversations like, and what gave you the courage, I think, to dive in at a time when, probably a lot of people were saying no thanks?
Yeah, I wasn't there myself when this happened, so I'm kind of copy-pasting what my colleagues did in the past, but at its core, Coinbase had a little bit of a trouble finding support And even when they found it, they didn't really find a technology solution that could help them process these payments, this money in the thoughtful way, or in a way that would help them with both the compliance aspects and the operational aspects. And so we ended up being internally building what we call the sub ledgers, which is kind of a simple concept but super, super powerful, which is, all right, you can generate an account for that user of a certain partner in between, essentially speeding up all the reconciliation processes. So the money would land exactly where it has to land. There's no complicated money movement that has to be done inside your platform to reconcile payments that you may not know who they belong to. And even later, you're always going to be able to split the funds properly user by user, which brings advantages both to the bank and to the company, because at any point in time, you have a real-time updates on what these balances are. Again, we don't probably as consumers appreciate that as much, but when we send money to someone or something, keeping them in order at scale over the many years, still pretty complicated process and user friction. So one of the reasons why Coinbase was really able to do that is also because of that activity that we were able to build for them in the very early days of their journey. Yeah.
Interesting. Rachel, I want to come back on the extension to Anchorage's business that Sergio mentioned, but Sunil, first, I'm fascinated with these stories of there was a courage moment in which an established company decides to start offering digital asset related services. Do you recall that and what that was like? And I want some emotion here. Like, I want arguments in conference rooms and people storming out saying never. And,
Well, I can. Well, let me give you a little bit. So a couple of
Thank
years
you.
ago, we started down the path of working with partners in the ecosystem to explore stablecoin transactions. We looked at NFT because a couple of years ago, everybody was also looking at NFTs as ways to exchange value and loyalty. We had some really cool conversations in the boardroom that says, what the hell are you doing?
Yeah.
And
That's the part I want to hear.
And this makes no sense. What type of value is actually being exchanged that's any different than what you could use your MasterCard and Visa card for?
Right.
So that was a couple of years ago. We've evolved since then. And we were also front and center with a lot of the regulatory bodies that were advising financial institutions that they also needed to stay out. So SAB 121, we had a couple of things going that kind of closed the door on any initial experimentation that we were doing. So the last couple of months have been really interesting, working with the Paxos team, the Solana team, and others, where we've seen a huge shift in terms not only internally at Fiserv, but also with the constituents we work with every day, financial institutions, merchants, intermediaries, all trying to figure out what's the cost equation here to support stablecoins, what's the end game in terms of value, what can we do from a programmability perspective, and what use cases from a last mile perspective will win, and where should we start? So it's been an extremely exciting last couple of months for us, and we've done a lot with the help of Alex at GDN and Shiraz and team at Solana, trying to get up to speed, get our executives up to speed. And I think there's a real acknowledgement that there's an opportunity here, but we're still working through what are the true incentives in the network, what are the true rules of the road that are needed. A lot of the banks that we talk to are willing to work with stablecoins, but they're asking some kind of general questions like balance sheet treatment, what else is going to happen, how do I do XYZ off-chain versus on-chain. So it's been a great journey.
Fantastic. Rachel, from an operations point of view, like this extension of Anchorage out of its original business into this space, big difference, right? A lot of different types of partners, and now a lot of what your specialty is in kind of regulatory understanding and comprehension. Been a busy time for you.
So, I mean, I would just say, I was actually just at the OCC last week talking about stablecoin issuance and what that looks like and what we think the risks are and how those operations work. But one of the things that, we talked about, what Fiserv is, and we talked about what Cross River is. At its core, Anchorage Digital is a security company, right? So we were founded by 2 security engineers, and that is the product that we offer. We offer security, right? That is wrapped in a financial services charter, right? A trust charter from the OCC. So when I say this, when I think about the operations, and I look at like our normal custody operations, and how we, verify institutional intent and how we make sure that we're, processing transactions correctly. And I, stack that up to what we would do if we were to, do any kind of stablecoin issuance. Those processes are the same, right? On the back end, there's a little bit of a difference in terms of like reserve management and making sure that you're not, minting out of reserve. But by and large, like the security aspect around it is really the same thing. And so, when I talk to any regulators and they say, oh, well, this is like really different and really scary, no, this is just a financial services activity that we're pretty good at with some reserve management on the back end.
That makes sense. So, Luca, I worked at a couple of banks in my days, and I find that banks, who work at a bank, there's a certain pride in the organization. Some might call it hubris or, just pride. Do you think banks will develop capabilities for good interoperability, or how are they going to build those? Are they going to have to acquire them? I mean, banks started by saying, we don't need public blockchains, we'll build our own. We kind of know that that's not where this is going to end up. So how is that going to evolve with larger traditional banks, terrestrial banks, I call them?
So first thing to keep in mind, at least for my mental model, is that you can be a bank or you can have a bank charter, and philosophically the behavior and the posture of the company change a little bit when you start thinking about that in those terms. The second level of ideas is, what constraints do you have because you're a bank? And very often could be the people, the processes, and the technology. On the people side, do you have the right skill set? And what skill set do you have? What is your posture towards innovation in general, crypto and non-crypto? Processes, we can deem that as a consequence of maybe people and technology perhaps. And then technology, what dependencies do you have? What legacy do you have that you can or cannot change because of constraints of any point, right? So that's kind of my mental framework for splitting who's going to do what in the crypto business. And I think the resulting conclusion from this is certain banks are not going to touch crypto because they're not in the industry. Doesn't matter. They shouldn't. That's fine. Some others will focus on custody because they're custodians of all the other assets. They want to go there, and so they're going to put all the eggs in the custody basket. Some others are going to be focused on money movements because, again, that's what they can do and what they cannot do. And some others are going to be focused on other aspects. Could be lending, could be maybe trading, etc. But I have very little doubt that a huge portion of the banks, especially weighted by size and asset size, is going to go into crypto one way or another one. And generally, what options do you have, right? You have 3 options or 4 options. You have the ability to build a thin layer of APIs on top of an existing legacy core, and that's definitely a path. The risk is the two will operate at a different speed with whatever risk this implies. The second option is you have your own technology and you focus on the use cases that are specifically amazing because you own the technology stack. And then the third one is you go through providers. And again, here we go back into, do you go through providers for a custody offering, or you go through providers for some other like trading desk augmentation or whatever other aspect people will want to do, but they're going to specialize in one. So my kind of simplistic answer to what you just said is most banks are going to look at crypto one way or another one. The way to get there will be very, very different, and they will manage different risk in very different ways. But at the end of the day, it boils down to probably people and technology, and as a result of that, processes, and based on what they can do, they will focus on the market.
And just a follow-up, banks love, especially trading banks love volatile assets, and the volatile digital assets are certainly, I'm sure, mouthwatering to them. Will it be stablecoins that lead or follow, or will be separate? They're kind of separate units of banks, so that's separate people. Does that complicate things, or does that create more of a case to attach resources to just doing things with blockchain assets?
All of the above, right? If we follow the split between the banks that are going to go into multiple segments, stable coins could be extremely interesting to the set of banks that are going to be looking at thinking of blockchains are just an additional payment rail, just an additional money movement rail. Like if you really think about it and zoom out just for a second from your question, the big innovation the blockchain is really bringing, at least that's the way I think about it, it's a global settlement network. Like I know we have reusable rockets today, right? And where we have them, we don't talk about the fact that the engine has gotten much better, the technology and the landing technology has gotten much better. We don't talk about programmability. We shouldn't talk about programmability and decentralization and many nodes and incentives. We should talk about what the benefit of that is, and the benefit of that is a global settlement network. Finance is obviously trapped. Everyone knows this. Finance is it's obviously trapped into different fragmented systems. All of a sudden, from 8,000 different languages, we can move to 5 languages. How powerful is that, right? So now translate that into stablecoins. Stablecoins will be that unit of value transfer that will travel on global networks. So all of a sudden, we're telling the banking system, global banking system, hey, you can transfer these balances across the different players, banks, non-banks, and in a way that is globally recognizable, which is both appealing in the local markets and in the global markets. And so when we talk to players just to do some discovery, et cetera, one of the benefits that comes up all the time is, you know what, we're thinking of doing stablecoins, not because necessarily we have to be in crypto, but also because we do one integration and we get global rails for all the systems that we interact with. Like that's incredibly powerful. I'm not sure the crypto industry is capturing this outside of the stablecoin issued value proposition, but that's like a super clear angle that will make most banks interested in the asset, in the class in general, whether it's for volatility, whether it's to play in the volatility, whether it's to support the volatility, whether it's to do other use cases, whether it's to do custody, etc. But becoming interoperable with the stablecoins will be an imperative over the next few years, one way or another one.
Interesting. Sunil, you sounded like you looked as if you were agreeing. Do you have thoughts to add to that? I also want to know, you mentioned SAB 121 before and how sudden it came up. I'm interested, I always want the drama stories, like what was it like when that kind of fell upon you, and the shock and the
so
response?
we actually
just want a good story here.
we actually
we all know that everything else is going great.
Yeah, we had a really good pipeline.
Yeah.
Till SAB 121 came out, and we had like about 12 banks ready to go and jump on different types of use cases, whether it was crypto exchange or whether it was just buy, sell, and hold Bitcoin, and then everything in just one day just kind of closed shop.
Right.
So that was disappointing not only for us, but for a lot of the institutions, because they knew the business was going to go elsewhere. And they were trying to do this to keep business. The only thing that I guess I would add to kind of what the panel has said is that I agree with most of it, is that we have to be thoughtful on last mile, right? I think there's a lot of panacea associated with stablecoin right now, which is great. I just don't want to create another set of currency pairs that are based on stablecoin as opposed to based on fiat. And I think what we're trying to figure out, just like everybody else probably in the room, is look at different personas, look at different financial institutions. I think what's interesting is I've got actually more calls from billion-dollar asset and lower financial institutions that are more aggressively looking to get into digital assets than the bigger guys are. The bigger guys seem to be cautious, and they've got a lot of different pilots already going, like JPMC. They've looked at treasury operations, just low-hanging fruit where there's efficiency. The smaller banks are much more aggressive because they're looking to use this as an opportunity to bring in low-cost deposits. They're looking this as an opportunity to differentiate themselves. Most of the smaller banks live in one or two different communities, so they have maybe 3 branches, 2 branches. So they're trying to figure out, if I'm going to be a financial institution going forward, how do I get this bank to be a trusted node on a much broader network? And as a trusted node, people come to me for on-ramps, off-ramps, and a bunch of financial products that they can't find in other places because I work with certain chains. I can deliver certain financial products, whether it's tokenizing RWAs or other things. So those are the things that, and we've got plenty of community banks that do a lot of good in the country, and they're looking for what's the next chapter for themselves. The regionals and the large financial institutions, like I said, they kind of absolutely see the efficiency play. They're looking to see how they can support global money movement, not only for their treasury operations, for large corporations. But when you look at even use cases like Zelle, or you look at Pay by Bank that's emerging, right now they're emerging on TradFi rails. How can we do that on a stablecoin rail or a blockchain rail? So these are some interesting use cases that come with a different set of incentives and commercial economics. And we can't lose sight of that either, because that's what keeps all of the parties in the ecosystem incentivized to offer these services.
That's incredible. I mean, again, like from the first panel, it was demand led, right? We weren't building a lot of stuff into the ether, for lack of a better word. Rachel, I guess from your earlier days at Anchorage, like all kinds of people are coming in. Anchorage was built on a demand model too. Hedge funds and crypto wealthy people who wanted better custody solutions. Is that expanding directly to you, or are you seeing serving that new cohort more and more?
Yeah. So when we think of customer personas for us, right? So like, yes, we have the, the hedge funds, et cetera, but there's also this entire wealth contingency.
Yeah, let's talk about that.
Right. And then there's like stablecoin usage there, and that's huge. And all of the larger banks are talking to us about that, to be able to provide that capability. I mean, I think that we've always seen that, but we've seen that grow over the past. I mean, even through SAB 121, where people were saying, "Oh, well, we're going to be fast followers," and but I mean, we've been working with like large financial institutions on this for years, right? To make sure that we are operationally capable to provide all of the subledgering that is required and all of the asset support that's needed. When we think about like stablecoin usage, and I want to get back to some of the points that Luca was talking about. Anytime there is like the opportunity to do any kind of like profit taking, right? A large bank is going to consider it. Like, you can't really ignore that. And so when you think about,
when you say profit taking, you mean when they see a profitable opportunity to pursue it, right?
Yeah, that's right.
Yeah.
And so I mean, there's a large volume of activity happening in stablecoins, right? Like, what was it, like 24 billion or 24 trillion in like 2024? I know the preponderance of that is a trading use case, but there's huge amounts of it that are really like about payments and cross-border payments. And that's not something that any large financial institution can responsibly ignore. And so, of course, we're seeing large players talking to regulators, talking to us about how that would look, how like things like all the stuff that you're talking about, like balance sheet treatment, like how do we think about wallet infrastructure? How do we think about the operations? So there's all the stuff that has to like fit into all of the things that banks have to do to be regulated. But it's not a when. This is like happening right now. And there are banks with roadmaps that are like being executed on.
And how those roadmaps were in drawers that were locked 6 months ago.
Yeah.
Okay.
Yeah. I mean, look, like the world changed with this last election, and like as we're seeing the heads of agencies come out, and as we're seeing lawsuits being dropped, as we're seeing orders being closed, we're seeing much more room for financial institutions to have the psychological safety to explore what they want. Now, what ends up happening, and like to Luca's point, like this ends up happening in like different places in banks, right? So you have like wealth, and that's going to be different than treasury management, right? And that's going to be different than like whatever use case. But eventually, all that's going to kind of come together into a more cohesive crypto roadmap. And so what we're seeing is like taking meetings with like different teams of like the same bank.
Who are not aware that you're meeting.
Well, they're aware, but there's just like different
Right.
use cases,
Right.
Right.
Yep. We're going to have to wrap in a moment. Luca, I'm going to give you the last word here. What would be a great outcome of the next 12 months?
For me,
For you. Let's just say
For
for you.
me.
No,
You personally.
everybody cares. They do.
I would say the regulatory environment is something that we're all very optimistic, comfortable, and love. And so that part has evolved quite a bit. You said it. I would say the last 12 months is where the last mile will actually be important. There's still a couple of open questions that seem pretty. Maybe we move as an industry from having the roadmap in a vault. Now we can possibly like put it on a table and start talking about things like in general. But still, there's a couple of missing points. Like, can banks hold fees or crypto in principal fashion on the balance sheet, at least to pay for fees, more in a binary yes, no type of thing? Can banks interact with self-hosted wallets? Can I send a transaction to, like, what is the banks can really do? As boring as it is, there's still like a little bit of friction in that process. And so I would really love if those things become, are transformed in some level of legislation. And the other thing is, if this happens, then it's pretty exciting because we can rely on the fact that in 3 years we're not going to be reversing to
That's right.
to something like that.
We'll
So
be
like
make
the
so much progress we can't revert all the way back.
exactly. So the progress is something that we're very excited as an industry, and we hope that it's going to stay. We think it's going to stay, but we need to make sure that it's going to stay.
Fantastic. Thank you so much. Thank you, Sunil. That was great. Very good. Thank you, Luca. Thank you, Rachel.
Thank you so much. Great.
I saw him a minute ago. Hey, Mark, how are you?
Testing.
Hello.
So I guess everybody knows all your guys' backstories, so my backstory question isn't going to work, right? Everybody's already, I guess.
You know our backstory. You'd wonder who decided to put us two on a panel together. It was a bad idea.
Why is that? Let's go.
You first.
No, I mean, I'm joking. So Mike and I worked 15, 16 years ago at Google to launch the first iteration of Google Wallet. So we have a long history together.
Shiraz had 10 years of payments experience at that time. I had 10 days of payments
That's
experience.
right. That's right.
That's how Google operates.
So I'm sort of
That's why Google
responsible
Wallet.
for bringing Mike into this world. So you can thank me or criticize me.
And
The
how does
latter.
that make you feel, Mike? Let's turn this into a
Humbled. So I would basically equate it to stablecoins today, right? I feel like most of the folks in this room have been thinking about digital fiat equivalents, but had no idea what it would look like, whether it would be allowed, and so it kind of feels like that moment when call it the biggest tech companies in the world, Google and everybody else were just like, this is the future. It's the Netflix moment for money, and it really wasn't 15 years ago. And basically it wasn't because what was being built on legacy financial rails, technology that was many, many decades old, with so many different stakeholders in the value equation. Now, not all of that has changed, but I think the rise of fintech in so many different areas and consumer and business expectation around UI UX, people and businesses expect money to be easier than ever. It hasn't been quite yet because of traditional financial rails, multi-day settlement, multiple intermediaries to send money internationally. We are now at that moment where we can 10x.
I just need to, like, how hard was it to maintain that level of enthusiasm during periods up until whatever a year ago when everything seemed to be moving so slow?
So it depends on where you were. I was fortunate to be at Google, and they paid me well to sell products that weren't any good.
Positive
So
carry.
it was great.
Yeah, that's good. Positive carry is awesome. Yeah.
Now that's why they're firing everyone.
Yes.
Loaded.
I'm sorry.
Well, were you talking about back then or no? Because
No, I'm talking like up until recently, when
Yeah.
I think a lot more of the focus, at least what we were experiencing, is stablecoins fine, but look at all these other cool things. And of course, what Solana has been, I guess, known for mostly has been much more volatile assets and adoption more in eyeballs in terms of exciting things, right? Rather than utility things. This is a utility thing, super important, but how hard has it been to keep it front of mind when there was so much other noise?
Yeah, well, I would say like I've been in the Solana ecosystem 4 years, and the nature of my job is radically different from when I started.
Right.
It was like, hey, let's do some experiments, pilots, like proof of concepts, like Solana Pay, right? And yeah, and everything was distracted with NFTs and all the stuff. I felt like a fish out of water. Now I feel like I have a payments job again, and like audiences like this, instead of being around a bunch of degens. No offense to degens, but this is like feels like we're at the grown-up table. So,
Right.
so in terms of staying focused, I mean, the great thing about the founders and the ethos of Solana has been laserly focused on just one thing, which is network performance, and I think a lot of things follow because of that. There's been an incredible economy of things that have happened on Solana. And in fact, those things have actually helped stablecoins. So in fact, we can thank Mike for Pump.fun, one of the 6-man
I did not invent it.
investments. But Pumped Up, meme coins are a joke or whatever. But if you think about the amount of stablecoin liquidity that it brought to Solana,
Yes.
which is now money on chain, which needs to find other uses, right? So
I think whenever those sentences start with, we all know that this was a joke, but the last half of the sentence is, look at how much liquidity got moved efficiently. I think that's a result in itself, right?
And how many new wallets as well.
Yeah.
How many new wallets? Seeing a Solana address at the bottom of a very famous web page, 3 days before inauguration.
Well, I was going to say the
Pretty cool.
canonical meme coin there,
Right.
USDC stablecoin market cap on Solana doubled
Yes.
from 5 to 10 billion.
Yeah.
And that money is on chain, and now there are payments use cases. So and now
Right,
they're-
and that
and
just
they're-
happened over a weekend. That
Yeah,
was right.
yeah.
No, I think that's a much underappreciated kind of event. Mark, you and I have talked about people being able to trade stocks 24/7 all over the world. So this is a different context. So you're working on this too. How do you split your time or thinking about payments or stablecoins with the consumer side of Kraken?
Great question. So they're pretty similar. Permissionless, 24/7, on-chain, built for everyone. Whether you're talking about stocks or whether you're talking about stablecoins, I think that's really important. It's why I think the global dollar is so important, because the existing USDT and USDC monopoly without yield, without accruing benefits for everybody in this room is a problem. It's something we have to solve. It was why I was excited that we didn't create whatever Kraken USD or something like that, and I pushed really, really hard to join this network instead. And it comes from the exact same principles that are crypto principles and Kraken principles of just like on-chain, as decentralized as we can. Stablecoin's probably never going to be fully decentralized. Lots of problems with that kind of model, but this consortium is as close as you can get, and that's why it's so important to me and to Kraken.
Very basic question. Let's take a new US Kraken customer. Like, what do you want their journey to be? They're coming in with fiat, and what would be your ideal path for them of adoption of products, including global dollar? Do you want them to get into global dollar right away and then look around and see what they're interested in trading otherwise?
Yeah. I'll leave speaking in New York,
can
so I
keep
shouldn't
going.
say this. No, it's important. Probably not. to start with.
Yeah, it's not a good
Americans.
panel answer,
This is
Mark.
the only country in the world where I still have to sign with a credit card and all sorts
Right.
of things. And I think actually Americans might be actually some of the last group to adopt global dollar. The reality is 4% plus on US dollars is maybe the most exciting possible thing in Canada that I can imagine. I'm Canadian. We're not quite there yet. Lots of other problems with the regulators. But that's true in many, many jurisdictions around the world. This should be I do believe global dollar is better than holding fiat. And we're going to see it. We're going to see the same way we've seen actually in the TradFi world, this like mixture of more trading companies and banks. Robinhood with a credit card, they're a trading company. How does that work? I think we're going to see exactly the same thing, even more so with stable coins and crypto companies and otherwise. And so you join Kraken, you save your money there, you use a card there at some point, you transfer to your friends, you pay your bills, and you buy Fartcoin from time to time.
Right. Why not? Yeah.
And maybe stocks
Friday
too,
night.
actually as
Oh,
well,
yeah.
right? And so all these things I think are very, very similar and connected in one ecosystem. And very soon we're going to see this sort of the dividing line between like the crypto version of stuff and the TradFi version of stuff. I think we're starting to see that disappear.
Shiraz, I mean, I'm neither young nor a degen, but I'm, worked for CoinDesk for a couple of years in the index business. I find once you're on chain, it's a pain in the neck and appealing to off ramp. Is that the core of what the mentality that you're trying to do to increase wallets, increase users, or what do you want the experience to be for the person who's going to become a
I think
consumer?
if you go to the core of Solana, it's probably we're less thinking about the application layer and more on the really deep layer of infrastructure.
Yep.
And I think I was thinking about a good analogy here. So how many people remember the company Net Zero?
Oh, sure.
Okay.
Internet provider.
Yeah. So dial-up.
ISP.
Yeah, dial-up
Sure.
internet, right?
Yeah.
So, yeah, exactly. So imagine imagine you're a content provider and you have infrastructure that reaches different users. And so I'm going to be multi-infrastructure, and the content you're providing is just text files or something, right? So that's all fine. But imagine overnight you have 4K streaming video, right? And one of the infrastructure providers is fiber optic cable. The other is dial-up. At the time you're serving text,
There's like DSL in there.
yeah, let's throw DSL.
Yeah.
So there's like it's like dial-up, there's DSL, and there's like fiber optic, right? When you're serving text, it doesn't matter. But then when you go to streaming 4K, it does matter, right? So I think for us, it's really the focus on infrastructure. Today, stablecoins are, I think the M2 money supply is like 24 trillion. So stablecoins are 1% of that, right? So we have to get ready for, I think we're all excited about it, but we're not really scratching the surface. So infrastructure makes a difference.
How do you demonstrate that? Like, how do you prove? Because you got the speed and the track record and the bandwidth. How do you demonstrate, especially to skeptical financial institutions, that hey, you want to settle on Solana?
In a way that I hate to have to do, but I point to certain network events like the Trump meme coin.
Right.
An asset went from
I'm
zero.
glad you said that, though, because I think that that's a fantastic example.
$0 to $80 billion in market cap in 2 days. Like the infrastructure providers were all buckling. Like I was, Goldie from Fireblocks was telling me about how they were able to kind of service and the RPC providers and whatnot, but the underlying network, held up, right? And that's the only thing. Everyone can be like, hey, we have this bandwidth, this, latency, but nothing matters until you test it. And we got a lot of flack. Solana got a lot of flack for the outages. But if you don't have outages, like you're not pushing your infrastructure hard enough, right? And Solana went through that, learned from it, and now I think the infrastructure is very resilient and battle tested. So.
There's this assumption that TradFi bank infrastructure is any good.
Right, that's right.
Spent most of my career in the TradFi world trying to find COBOL programmers. This is still a thing that exists.
Yeah.
Throughput there is mostly hacked together. It's a lot of netting. It's
And
a lot
there's
of stuff
outages
on
there,
top,
too.
and there's outages there too. And so I think trust, a lot of us, but there's a lot of trust for banks, and it comes from a long time of solving problems without really talking about the underlying tech too much, and that's where I hope we'll get to. And Solana's done a great job of that. And so far as the less we're talking about it, actually, the better it is. And
Just accumulating track record.
yeah, exactly.
basically.
Just continue accumulating track record, and it sort of the trust comes from not having to talk about it very much.
Right. Mike, one of the early easy talking points is that as an asset class, crypto started with retail. It started as a hobby, right, or as a passion, and then is swimming upstream, unlike every other financial asset class. Are we going to keep going this way? Are the new wallets going to be individuals, and that's going to create this institutional demand curve, or has that changed?
Yeah, so I think it is going to be a retail-led revolution. Just
That's
because
incredible, by the way, right? I mean, in a way, right?
It is. It's because it's like unstoppable and permissionless. So basically, I do care about the app layer. That's where we tend to invest as a venture firm. And there's going to be tens of thousands of apps and interfaces, that will tie into stable coins and other tokenized assets on Solana and on other networks. And we've invested in a number of those, that we think have unique advantages. But the vision is, if somebody in, just pick a country, the Philippines can earn some money or get $10 via remittances, store those $10 in USD in a self-custody wallet, have access within the app that they're using. We invest in one called OffRamp.xyz, have access within that to tokenized equities. Equities are something like they've never, I can own Tesla. Okay, that's kind of cool. Okay, that's the next gateway. I can get on chain from within the app. There's an in-app browser similar to what Coinbase Wallet has. Okay, I can see what other fun stuff there is. Oh, I heard Trump's got a coin, sure. So there's some speculation there. And just it is that gateway to start discovering things while hopefully not burning it all at the casino. But I do think that economy and that sort of gateway to tokenized, it's basically tokenized assets on chain, with fiat being obviously the standard one. It's sort of the bottom. I don't want to say the bottom of the pyramid, but it's the fundamental thing that people need to be able to store value in. You're giving that access to more people globally more easily. And now, because of Visa, MasterCard, the card networks and other off-ramp providers, I can actually spend those dollars I get at increasingly, the fees are going to drop. It is so deeply competitive at every layer of the financial stack that basically you have the ability to spend in the real world as well as in this fun, interesting, hopefully lucrative on-chain economy as well.
I had dinner. My wife and I had dinner with two terrestrial people, right? And instead of splitting the tab, I said, you're going to open a wallet, and I'm going to send some Solana and some USDC to you, so you go play. Otherwise, I'm not paying you, right? Or if in a week you're still angry at me, I'll give you cash. And they did it, and they a bunch of questions came in. So I think the evangelism part, with people who are reluctant or just have let this go by.
But you could also give them, tell them to download Sling Money, for example, right? And,
right.
And that they don't necessarily need to even know, but under the hood is,
So under the hood, that's right. I was very get a seed phrase, learn the system, at least get your own confidence, know where this started, right? Before it's all abstracted away, so that you could say you could learn how to drive a stick.
Fair enough. Yeah.
Right? Is that going to be necessary?
Maybe
or
not.
Do I need to teach my 17-year-old how to drive at all? I mean,
I think it depends on the user. It's not a monolith, but I think at scale,
these are
the
nerds,
great thing
by the
about
way,
great thing about a Sling Money is that you can be like, hey, it's like Venmo, but you can send to 150 countries. You can, and those people can have those funds instantly, and the fees are you're not being gouged like some of the other cross-border remittance apps.
Well, but I actually think I'm going to disagree a bit, Mike, because at least on the money side, in-country fiat works relatively okay. Mostly because a bunch of people are doing yoga behind the scenes, trying to fit old systems together in ways that you don't really see.
You hate the old systems.
No, I don't hate them. They're just slow.
Right.
They're slow, right? And so Venmo does a lot of stuff so it looks instant. There is nothing instant about it behind the scenes. Business payments, especially internationally, are something that businesses notice and are a huge pain in the ass. And when we're moving money between Europe and Canada, there are 6 banks in the middle. The money can get stopped at any one of those banks. By the way, there's no actual system to know which one it's at, and it doesn't go through the same 6 each time. And I do think, in addition to a more like probably other retail use cases that force money online, which is maybe a little different, there will also be, just around stablecoins, this need for small, medium, large, like those smaller banks and medium-sized enterprises that don't have access to JP Morgan or Citi and the giant, heft that those few banks can provide. I think stablecoins is a huge unlock for them. And actually, we see a lot of that already happening through Kraken behind the scenes. We do a ton of business for corporations and other retailers and things like that. And I expect that piece to be one of the bigger drivers over the next 12 to 18 months, as this gets from like this like scary new thing that people are doing for the first time to something that's actually just the easiest way to move money between the Philippines and Canada.
You're exactly right. So when I speak, it's more like a VC, like big, but like what's going to capture the imagination of the world such that stablecoins become inevitable.
Right.
Certainly the B2B value flows, like we've invested in business banking apps, so stablecoin first accounts. Those businesses are clearly doing much larger volumes and solve a massive pain point today. Pumped up fund can't get bank accounts, right? So they have to put their money either in a multi-sig or with these sort of hybrid stablecoin first providers. So yeah, the pain points, the scale of dollars, clearly business first. But I think in terms of imagination, usage, and sort of perpetuating that, we've moved from traditional financial rails to, what do we call them? Internet, what does Solana call them? Internet
Capital markets.
Yeah, I think that the retail user is going to lead that.
So the retail users has been attracted mostly by speculation or entertainment, right? My friends who I had dinner with, they were just evangelized, like they were attacked. But then once they were on the other side, they were comfortable and they found things interesting. So what's going to be the next unlock, person to person? Is it going to be more? Is it going to be a payment application? What's going to, I guess, supplement trading or fun, which will get people over the hump and say, oh, I have some stable coins now and I'm comfortable with it and it's just part of my life. Any thoughts there?
I'll start. So I think we're going to move from pure native crypto, gambling to like more sports betting,
terrestrial
prediction
gambling
markets,
using stablecoins.
Yeah, novel things. So we're going to move out on the speculation, like literal lotteries on chain that are global, things of that nature. But you talked about earlier, 4 and 5% better than bank yield. I truly do believe will be the next one. That's not
Actually, here's a question I've just remembered. I'm dying to ask, and this is a great panel to ask. Like, is it a convenience of history that interest rates were 0 when all this started? Any thoughts there? I mean, there was no expectation of yield in 2020, 2019, 2020, and then suddenly in 2022 there's an expectation of yield because there was no opportunity cost. So it was almost like a great playground for things to grow when yield was not an expectation.
Well, didn't it make it harder because it was sort of a gray market at that point, right? And so Tether was used, even though like it wasn't a great business. They were kind of patching everything together.
Sure,
it became better for that. But your point is, would people have demanded to be paid immediately?
Correct. Would stablecoin adoption or satisfaction been slower if people realized the opportunity cost at the time, or if they're just trading 70 or 80 ball assets, or whatever,
Well, I think that's what's
because an unusual period in history, right? When rates go to 0 to 5% in 18 months, pretty crazy.
That's why we're excited about USDG, because
Right.
I think the whole philosophy of this is, money is a network business. Let's bring in the network participants and let's reward them. And so I think there's certain use cases where there's higher velocity, where maybe a platform doesn't even think about it. They're like, I have money moving in and out, so yield doesn't matter. But it adds up. If you're kind of moving a lot of money, you're still having custody of that at scale. It adds up. So I think that's given the point in time we are at now. I think like we're bullish on USDG as sort of the the alternative to Brad Garlinghouse's new stablecoin USDC.
Okay, no shade throwing.
Well, it just hasn't even happened.
Okay. I do want to ask a question about Solana. I think if I buy a bagel and coffee and execute via Solana, that's great. And if somebody moves $1 billion and is watching that very closely, that's on the same layer. I mean, that's not how traditional money works. There ought to be. What do you foresee the layers of demand for security versus versus speed or cost or anything?
That's the beauty, and that's the thesis, right?
Right.
One global state machine.
Right. So you think one layer is going to do everything?
I mean,
I know that's everybody knows that, but I wanted you to reiterate.
But yeah, no, and there's, I mean, I don't want to put people to sleep, but when you go under the hood, there is a lot in the protocol that enables this, right? Parallelized execution, not just of block production, but compute, local fee markets. So let me just take that as one example, right? And again, I hate to always go back to the Trump example, but it was a very sort of defining event. So local fee markets mean that the pricing for a transaction is not done with global supply and demand. It's done at a local state level, so the state you're trying to access. So if you look at the chart of average transaction fee and median during the Trump meme coin launch, it was very different. Meaning, if you were trying to buy the Trump meme coin, your transaction fee spiked. But if you were using it, trying to buy a cup of coffee, you're still paying 1/1000th of a cent. So it's tooling like that that enables everything to be on a global state machine. The benefit of a global state machine is that everything is interoperable, right? So we talked about Pump.Fun and how it brought in this economy. I think what's exciting about the Solana ecosystem is that you really do have an economy of things happening, and everything is interoperable. So if you launch a loyalty token, that same token, it's the same token standard that can plug into all of the DeFi protocols.
Right.
Whether or not you want to put those Lego blocks together is up to you, but that's what this infrastructure is built for.
We're running tight on time. Maybe one more comment each. I know I want to ask you about Kraken user experience.
So one thing I'm concerned about with this, like Lego and everything, like everybody says they want to issue $1. Like we're gonna start to run into a problem. I don't know if one of the earlier panels addressed this, but like there's a lot of branded dollars coming out. I think that's going to be a real user confusion
NFT
point.
Dollars, right?
What's that?
Basically dollar NFTs or
yeah, my
right?
goodness. Like if every brand I interact with has its own dollar, are they, you're going to have pools for those and, app par conversion. So I'm really interested to see how we solve that. I actually think we do move to a world of, and hopefully the global dollar is one of them, but a world of, I don't know, 10 or 12 major coins, not a world of thousands of major coins, because that would be just a disaster of confusion, bad UI, UX, and make things worse.
Totally agree. Mark, final words?
The reason people start their own dollar coin is they think they can take all the yield for themselves. And we've kind of let them in crypto so far, which kind of nuts to me, right? Billions and billions of dollars all paid to single entities. I hope that stops this year, and I'm optimistic it will. And I think Global Dollar Network is a key part of that. And it comes down to the fact that you can still get the yield that you need to get, but you can do it in a way where you can still be interoperable with everyone else. And actually that message works on the stablecoin side. It actually also works on the chain side eventually. We probably don't need thousands and thousands of different chains in the end state. And so more layer ones that can do more things, that's exciting for me.
Cool. Thank you all so much.
Thank you.
Thanks. Thank you, Mark. Good to see you. Okay, we'll get started with our fourth and final panel. I'm a bit overstimulated now, so let's try to keep it going for another 25 minutes. Chris, I see your book outside.
Yeah,
Will you sign one for me?
I would be happy to, and for anybody else who would like.
Fantastic. What brings you here? I think we had an exciting, use your microphone. Whoops. We had an exciting pre-call. I think, what would you like to see happen in the next 1 year? Conditioned on what's happening in the legislature right now.
So I like to think about the change in policy from the previous administration to this administration. Policy's moving on 3 fronts. The first front is getting rid of bad policy, which is mostly a matter of personnel, relieving of duty people that promulgated the unannounced but official policy of the Biden administration to suppress digital innovation. That's well underway, but we've got to get nominees like Brian Quintenz and Gould and others through the door, Michelle Bowman. The second front is delivering on a series of somewhat unrelated promises that were made by candidate Trump, crypto council, a crypto stockpile. Those are all moving at the pace that they're moving, and not all that important in the long-term scheme of things. The most important one is, it's one thing to get rid of bad policy, it's another thing to get good policy and lasting and durable policy. And to get lasting and durable policy, we need legislation in Congress and we need rulemaking out of agencies, especially like the SEC. So far, so good at the SEC. As of last 48 hours, so far, so good out of Congress in terms of stablecoin legislation. Although there's a lot that's going to happen today to determine whether that legislation is truly good or what's going to come out. But what I'd like to see, to answer your question, I'd like to see those other nominees get through quickly so they can work at the agency level on good policy. And we've got to get a good stablecoin bill. We've got to get a good market structure through the door. I am of the belief stablecoin legislation will pass, and it will pass for reasons having nothing to do with crypto. It will pass because the last few treasury auctions have not gone according to plan. The demand for treasuries is diminishing.
Oh, we're going to talk about this.
And we need it. We need it. So anyway, I'd like to see
We'll get back to
legislation
that.
like this.
Oh boy, that's good. Okay. But I have to be kind to other panelists. From the Paxos point, how the heck have you been able to be so patient to wait for now?
That is a great question. This is on.
Yeah, you're good.
So, I think we've been able to be patient with this process because we were very early to the regulation game.
Right.
So this
in 2015.
In 2015.
Like you couldn't even go to crypto events, really.
Yeah, and we've been a regulated trust company in New York since 2015. We're very supportive of getting good, thoughtful stablecoin legislation in place, but it's simply kind of recognizing the model that we saw from the beginning that is going to instill trust in consumers and enterprise partners. So we're very glad to see this moving forward, but we've been able to have that patience because we're already doing it.
Right. My manners. People don't know maybe what you do.
My name's Leslie Chavkin. I'm the global head of policy for Paxos.
Right. And so policy means you're interacting with the Hill, the Washington. It means you're interacting with whom, and what's the objective? What are your KPIs?
The Hill, the administration, the thought leader community in DC. The priority for us is we really want sound stablecoin legislation, to Chris's point, that's durable, that gets it right, because we only have one opportunity. And I think for us, some priorities that we have around stablecoin legislation is that it protects consumers first and foremost, right? That they have trust in the product that they're holding, but that it also sets up a really fair playing field for non-bank issuers, right? We are the ones that have been driving innovation in this space, and we want to be able to come to the table, have a seat at the table, and compete with the traditional financial sector.
Absolutely right. Our company, we have a data company back at the shop, and you have a data company. It's critical. These things can't happen unless people understand and have transparency. What incoming calls are happening now that may not have been happening 2 years ago, 1 year ago?
Yeah, so for people that don't know me, I'm Jonathan. I'm co-founder and CEO of Chainalysis. We've received a lot of calls from different types of issuers, predominantly who are thinking about the opportunity to issue stablecoins off the back of legislation, or even just getting excited about the actual product and use case. And there's a lot of people even launching products ahead of legislation out there in the market. And I think that when people call us about that, they don't know yet what their obligations are. They are thinking about, hey, I'm a new issuer of this asset, and it could be a stablecoin, it could be a real world asset. I don't want bad people to use this asset that I'm issuing, but I also don't want to KYC every single person who holds this token, because the whole point of this thing is that I'm the issuer, and it floats out into the broader ecosystem. And so what we have been doing is building a lot of systems to allow for greater insight into the entire ecosystem and letting issuers decide what is the right framework for managing the risk of illicit actors abusing their platforms and the underlying asset. And really that's been sort of a journey with each of those clients. And one of the things that I'm excited about which would happen on the legislative side, and actually the follow-up guidance from the regulators, is giving that clarity over what are the responsibilities of an issuer in this type of environment, and what are some of the ways to think about risk. The final thing that we've been receiving is that people, especially at the banks, are looking at this in a different way to what crypto people look at this.
Okay.
And I think that the way that the banks look at this is that there is a much greater emphasis on some aspects of operational security and market stability than what we have had in the crypto ecosystem. Stablecoins in the crypto ecosystem have been like an absolutely incredible product. It's allowed for global businesses to be connected with an international settlement system that just works. And it's led to like a lot more trading activity and a lot more integration globally between venues than otherwise would ever have been possible. But really, when it comes to banks, like, they look at it and they're saying, I need to not just understand the stability of my asset, I need to understand the stability of everyone else's assets out there. And I'm much more interested in market contagion, and I'm much more interested in really understanding the governance behind all of these things and how all these things are connected. And that requires a business like Chainalysis to take a different approach to like understanding the whole, what I call like the USD on-chain ecosystem, which is a much broader problem than just an individual issuer and an individual coin.
So it's interesting. A bank might say, look, if I'm a dollar-based bank and somebody in the world does something bad with dollars, that's not on me. But if I engage with a stable coin and somebody in the world does something bad with that stable coin, it reflects on me.
Correct. And also that they are like, if a big bank is going to issue a stable coin or is thinking about engaging in some way with stable coins, the actual stability of that so that it actually trades at $1 is going to be something that they care a lot about. And if you look at how stablecoins are being adopted, and they're just like being cast out in the wild, which is like exactly what they're meant to. You have people arbitraging and bringing coins back to $1,
right.
But to measure that effectively across thousands of venues and tens of thousands of currency pairs is going to be a data challenge that is going to be quite difficult.
It's interesting because that is an incentive-based system, right? The keeping stable coins at their peg is an incentive base, and the incentive might be in the profit of doing it, or the incentive might be in having to pay for it. But I think that's right, an underappreciated point. That must be something that you have to talk through regulators with, right? The depegging risk. How much time do you spend talking about what happened in March of 2023? When USDC lost its peg over the weekend. How did you, that must have been a big case study for you.
Yeah, and I think what's been helpful in our conversations is just talking about the model that we have as a trust company, right? And what that does for the stablecoin. The fact that we are very transparent about our reserves. Everything is in cash and cash equivalents. Should there be any kind of insolvency, there is a way that that customer assets are segregated from corporate assets. all of that is very helpful in understanding that that dollar that you are putting in is the same dollar that's represented in your stablecoin, right? So I think that has been very important in the conversation.
Having worked at a firm where we traded put options on a certain stablecoin in a pretty liquid way, right? Almost daily. Yeah.
I would say that's also an important point too, because for a lot of policymakers, stable coins are still very new to them, and they lack nuance over how these stable coins are different from one another, right? That we are prudentially regulated, that conveys a lot to the end consumer, right? That's very different than having, say, a stablecoin issuer that's operating just with money transmission licenses. That doesn't have the same kind of protections. Or a completely unregulated foreign issuer, right? Where it's very opaque behind the scenes what's happening with that stablecoin. Is your dollar really a dollar?
Right.
So I think that has been a big part of the education journey in DC, is explaining that not all stablecoins are alike.
When you say the word peg, do they think of sovereign pegged currencies? Does their mind drift right there and think of it almost as a policy decision as to whether to maintain a peg? I don't know because there's no context, right? There's no mental model for something that is on an incentive basis kept to the value of a dollar.
Yeah, I don't know if the conversations are always that sophisticated.
Oh.
Yeah.
Okay.
Early in the journey.
Got it. Okay. I'm dying to ask this question. Okay, Chris, is the 10-year a chess piece now?
You know, the U.S. economy and the U.S. dollar is such a complicated instrument that it's hard to almost, I think in some respects, that may be the case.
It's the first time I saw the 10-year not act the way everybody expected it to, and some people needed it to. And it seemed as if the incentives were different, and it was now a game piece rather than a flight to quality asset.
There are dynamics playing out right now that can be very worrying in a lot of regards. And I'll return to the point I was making before. I think 95% of the driving force behind stablecoin legislation is to create more demand for treasuries. And the remaining 5 is simply working out which regulator gets oversight, which means, and at federal and state level, and how much, which means which committee of jurisdictions gets the campaign contributions from the industry. I hate to be so cynical, but that's what 5 years in Washington will do to you. And I also think it's inevitable that even if they are pegged identically, stable coins are going to trade at a premium or discount to each other, and marketplaces are going to emerge to work out those differentials to put the value on. And they'll be for things that Leslie described, how they're regulated, who regulates them, but also what's the exit charge? What's the time lag to get out of a stablecoin into another instrument? What fees are charged? All of that's going to be worked out in a marketplace. And at the end of the day, they are commercial liabilities. They're not sovereign liabilities. So they will also trade at some premium or discount to sovereign liabilities as well. So the world's going to get more complicated, not less, for the U.S. dollar. But the bottom line is, even if the politicians are focused on demand for treasuries, it's in the American interest to have the dollar continue to serve as the world's reserve currency. And part of that means delivering dollars to parts of the globe that where demand has been not met by the dollar in its analog state. What stablecoins have demonstrated is the global demand for dollars far outstrips the supply in an analog world, and the beauty of stablecoins is meeting that demand.
That's certainly a takeaway point for me, that the more stablecoins that are out there, you're creating new customers for U.S. Treasuries. That's definitely a
and if we can
point.
get back to some degree of fiscal prudence,
yeah,
and if we can approach law enforcement of the dollar in a better way than the wooden way we do with AML KYC, and not sacrifice our values. And by money carries values of a society. China's digital yuan reflects the value of a closed society where people are surveilled and controlled. Europe's digital euro also will be a surveillance tool by government, not by commercial entities. We need to make sure that the values of the dollar are reflected in all manifestations of the dollar, whether those are commercial manifestations or government manifestations. We've got to get the balance between law enforcement and individual autonomy and privacy right. We've lost that balance over the last 20 years under the BSA, the Bank Secrecy Act. I think stablecoin legislation opportunity to once again rediscover identity as a free society that respects the role of law enforcement, but not gives it privileges in which it's not entitled to under our Constitution.
Wow. Okay. If things destabilize more, I've found the yield curve is in a very uncomfortable shape right now, right? And if things destabilize more, what kind of things are you going to track? Do you track, by the way, peg level or volatility of stablecoin prices around their pegs and things like that? I mean, what do we look for if, let's say we go into a recession, traditional assets get more volatile, the dollar starts moving around quite a bit, treasuries, the yield curve move around. What do we expect stablecoins to do?
Yeah, the things that we track really closely.
Sorry, I'm getting all macro here, but it's
Yeah,
just,
no,
you know.
it's fine. I'm a recovering economist. The way that I think about this is, look, we track a lot of the activity that happens in DeFi and all of the on-chain activity. So I don't speak a lot about sort of trading activity inside venues, but we look at really like every on-chain movement of value and its significance. And so I think the interesting thing about, you know, the current sort of shape of the industry is that, you know, everyone is looking at DeFi liquidity. Everyone is looking at yield curves also in DeFi as well as in traditional instruments. And really what that will do, you know, depending on the dislocation or instability in global macro markets, like that, there's echoes of that inside DeFi that we track very closely. And really our customers at the moment are on risk parameters and are thinking about that in a very sort of normal way. And I think that what we end up providing ultimately is going to be some indicators where, like, hey, things are going to dislocate in DeFi and like you're going to get, you know, some bad things happening. And I think that, you know, teams in that space need to be better set up for success. And you know, teams are getting better and more sophisticated about it, but it's a very, very complicated market. And I'll say that, like, most people learn the lessons of previous financial crises again and again. And there will be, depending on what exactly happens, like there will be versions of
But
that.
many of them weren't working during the last financial crisis.
Right. And now they're there.
You
And
need
like,
old people.
yeah.
Old people are valuable here. Leslie, do you ever worry about, I'm thinking like, you know, the tech bubble bursting 25 years ago, what desk I was sitting on. Do you worry about contagion if one stablecoin hits a bumpy patch and the perception of the whole class?
I guess what I would say, if your stablecoin is appropriately regulated, it does not hit a bumpy patch, right? That
Right.
dollar is a dollar.
That
And
being said, I knew you'd have an answer ready because
Yeah.
this is not the first time, but I think there is the perception of contagion and then there's actual contagion.
Yeah.
And I think that would be a concern, right?
Yeah, and I think one way to address it, because there's been all
This
this.
is the fourth panel, right? We don't
Yes.
want to end on a downer, so we have
I think I got.
like 8 minutes left. We're gonna get super bullish right at the end, just to.
This is not a silver bullet, but I think one thing the industry has been saying for years is that we need a federal framework in place for stablecoins, right? And then it's going to drive retail adoption, it's going to drive enterprise adoption. Very soon we will have that. That is on the horizon. But what we do not have, and is still going to require a lot of work, is how you match up these regulatory frameworks from the US, from the EU, from Singapore, because it gets at exactly what you're saying, right? How do you encourage uniform standards around stablecoins that prevent these kind of risks? So even if there's a great framework in place in the US, what happens with a US dollar stablecoin issued somewhere else? How do you make sure that's safe and sound? I think that is going to be a very difficult process. I think someone has to take a leadership role. It looks like the US is willing to do that right now, but it's not going to happen without some mobilization. So I think that's going to be the next big effort in that, is how you stitch together these frameworks and make it something that's really holistic, so you can start to ensure that you're not going to have these stablecoin breakdowns in pockets that lack regulation.
Right.
Isn't it fascinating that we have dollar-based stablecoins being issued under the laws of foreign jurisdictions? We have France deciding what a a dollar-based stablecoin issued under the French authorities looks like.
Right.
We have Singapore regulating dollar-based stablecoins. At some point, the U.S. government has to say, wait a minute, we own the dollar. If you're going to issue a dollar-based instrument, we set the rules for it. You know, the United States stole the dollar to begin with. The dollar was a Spanish instrument. It was called the doubloon, or the pieces of 8. And we stole the S sign with the lines through it. The name dollar was the Spanish doubloon. The divisibility into 8 pieces, the dollar's divided in halves, quarters, and what used to be called bits, eighths. We stole the whole design element. Why? Because it was the most technologically advanced currency of its time. Well, now currency is advancing to digital networks. And we're doing what the Spanish did. We're letting other people take advantage of something we've popularized. The dollar ought to be trademarked, copyrighted, owned by the United States, and all rulemaking ought to be done by the U.S. government.
Interesting. I like that. Okay, we're getting bullish now. I like this. We're off of the contagion thing. We're off of the recession thing. We're into the regulated stable coins, or in a different class. I did. All of this was planned, okay? But now we're going to end, I think, on a stronger note, right? So one thing that can happen is if people get very comfortable with good, trustable, regulated stable coins, I can imagine weekend volatility of everything starting to decrease a little bit if people can trade risk a little bit better.
I think my optimistic view is that
only optimistic views for the rest.
Yeah.
5 minutes.
Yeah, my optimistic view is essentially that is much closer to payments than it is to sort of traditional financial markets. I think my optimistic view is that we've seen this week, you've seen Google essentially disrupt their own search model of saying that they generate $50 billion a quarter of revenue from adverts on search, and they've said we're going to take away the blue links and we're going to give people like actually a chat interface, and we're not going to say anything about what the advertising model actually does that sits behind that. And when I think about even what we do, I think a lot about like the content that we put out being consumed by machines, not humans. And actually, like when I first got into crypto, which was in 2012, people were talking back then about machine-to-machine payments as like the best use case for cryptocurrency. And I think that the optimistic view that if you get like stablecoins correct, and you can actually think about the model of machines or AI agents actually buying content directly from people like yourselves, like you actually get to a much better model of monetization on the internet, which supersedes sort of almost anything that we've seen in the cryptocurrency ecosystem. And so like that's honestly like the thing that could happen if we have like the best federal framework in place.
Fantastic. Leslie, optimistic final thoughts.
Well, I would not be working at Paxos if I was not very bullish on stablecoins. I think, where I see it, to Jonathan's point on payments, I just think there's tremendous opportunity for stablecoins to really revolutionize cross-border payments in particular. I come from a payments background. I worked at the U.S. Treasury Department before joining the industry, and you just see so many pain points that we, even domestically in the United States, you might not feel it day to day. As soon as you start sending money across borders, you notice how slow it is, how expensive it is, and stablecoins are a way that can really address that. Right? And that is a challenge that everyone from the IMF to the FSB has acknowledged is a huge problem, particularly for communities that are in need. So I'm really bullish on stablecoins, and I think once we have these frameworks in place, you'll really start to see it take off in the payment space.
Fantastic. Chris, final thoughts, bullish if possible.
Bullish. We're going to get stablecoin legislation. We're going to have a federal regulator of stablecoins, and we're going to see a proliferation of stablecoins. And they will trade at premiums to discounts, and I think those that have been doing this for a while, that know what they're doing, are going to enjoy tremendous success. I'll give you one other high point. I think it's really great to see the SEC back on its game under new leadership, really being a leader in promoting digital innovation. And I think whatever happens at the White House, whatever happens in Congress, the SEC is on a mission right now, and I think look ahead to great things coming out of that agency.
Fantastic. Great. That's our final panel, folks. Thank you so much to this panelist and for